Hi everybody, today I'm going to provide you an update on my stocks and unit trust portfolio, and I also want to share with you what are the 3 REITs that is currently in my reserve list that I have not added into my existing portfolio. As of 29th of May, my 10 US and 10 SG stocks is currently at a slight negative of 2.05%. However, the portfolio is positive because of dividends, and also I have taken some profits on some of the counter along the way. What I've changed since the 31st of March on my previous update is, first, I have sold off JP Morgan and I replaced it with another bank stock, which is called Bank of America. Both bank stocks are the stocks that I would prefer to hold for longer term, but at the current market juncture, as my portfolio is capped at 10 counter, so if I want to buy another counter, I need to sell off an counter. And what's the rationale of me replacing JP Morgan with Bank of America? As we know that early this year, there is a bank crisis and some of the banks have collapsed. And there's a divergence in share price between JP Morgan and Bank of America due to Bank of America holding a substantial amount of bonds. And thus there is a sell down of Bank of America shares, especially in Q1 this year. Thus, I take this opportunity to switch to sell off my JP Morgan at a slight profit and transfer the fund into Bank of America. These are the 2 stocks that I further add my position into the portfolio is Nike and ComfortDelGro due to the recent price weakness. And I also sold off Capitalescort Trust. I don't own Capitalescort Trust, although it's a risk that I want to hold it, but I was given odd lots by Capitalescort as they issue a dividend in specie by giving me Capitalescort Trust. Currently, there is a promotions of free brokerage when I would want to sell off this Capitalescort Trust odd lots on Poem's platform, and thus I take this opportunity just to cash out this small quantity of Capitalescort Trust. This is the current 10 holdings of my Singapore stocks. There is no changes in the counter, and none of them have crossed 5% in the total portfolio holding, and the 10 stocks contribute about 29.02% of my total portfolio. And this is my 10 US stocks holding. The new addition is Bank of America. I use it to replace JP Morgan, and the current holding is slightly less than 2%. Similarly, for the US stocks, there's no counter have hold more than 5% on the total portfolio values. And the US stocks currently have a total portfolio percentage weightage of 28.3%. So this indirectly means that I currently have more than 40% cash in my portfolio. And my longer term target is to keep the cash balance below 40%. And thus, I may add more positions along the way when there's opportunities. This is the performance of my portfolio as a whole, and currently you can see that the portfolio values and the capital amount is about the same. Currently there's a slight profit at current market juncture for my portfolio, and my cash balance currently is more than 40%. And for the month of May, there is a huge surge in my dividends. The main contributor are mainly from the Singapore stocks, where there's dividend payout for most of my Singapore stocks in the month of May. And thus the total dividend collected since the portfolio was launched January last year is slightly more than 700 Sing dollars. We expect that as this portfolio continue to grow, the dividend collected will keep on increasing. Now let's look at my unit trust portfolio as of 29th of May. It is currently still slight negative, and the best performing unit trust currently at this juncture is the Aberdeen Global Tech Fund, which currently is at a 9.8%. The worst performer is the JPM Greater China Fund, which currently is down 12.95%, but it actually have recovered quite a fair bit compared to last year low. However, the total portfolio is still at a minus 1.44% net loss. This is another view of the portfolio. We will compute on the analyzed returns wise. Since inception, actually the portfolio is down 7.47%, although the portfolio value is down only about slightly less than 2%. And year to date, the market have been pretty strong and bullish, and this portfolio have actually up 6.6% year to date. This is the unit trust portfolio. Unfortunately, since day 1, January 2022, until today, this portfolio have not been profitable yet. Nevertheless, I will still continue to do money investment on this portfolio, and I may do a restructure of this portfolio at the appropriate time sometime this year. Now, let's look at the REITs aspect and what are the 3 REITs in my waiting list that I may want to put them into my portfolio. These are the 38 REITs that is currently listed on SGX, and these are the 4 REITs that is currently in my portfolio. I have Capitalescort Trust, Mapletree Logistics Trust, which belong to the industrial REITs category. And on the diversified REIT, I have Mapletree Pan Asia Commercial Trust. We have shopping mall and office in Singapore, Japan, Korea, and China. Next, I have a healthcare REIT, which is a Parkway Life, where they got 3 hospitals in Singapore and a fair number of nursing homes in Japan. So what are the 3 REITs that is in my watch list that I may want to put into my REITs portfolio to make it more complete? So the first REIT in my watch list is Capitalescort Trust. It is the largest lodging trust in Asia Pacific with more than 105 properties. There are currently 5 hospitality trusts listed on SGX, and if you were to add the number of properties the other 4 hospitality trusts add together, in terms of quantity, they are still lesser than Capitalescort Trust. And in terms of market cap, if the 4 of them add together, they are just slightly more than Capitalescort Trust. In this comparison, this is why Capitalescort Trust was considered the largest lodging trust in the Asia Pacific. One thing unique about Capitalescort Trust is that it has a diversified portfolio. From here, we can see that the service residents take up 50% of their portfolio values. When compared with the other 4 hospitality trusts, they are mainly focused on hotel. While Capitalescort Trust, the hotel only contribute about 32% of their portfolio values. And they have student accommodations and rental housing where the other 4 hospitality trusts do not have. This makes the portfolio more diversified. And also that when it comes to hospitality trust, I will prefer income to be more stable. As you know, the hotel income can vary due to season. And thus, when I'm investing in REITs, I will prefer REITs to have more stability in their income aspect. And let's look at the financial data. Currently, their gearing is 38.7%, which is on the healthy side. Their interest cover ratio is 4.4 times, which is a pretty good range. And their adjusted interest cover ratio is not printed here, is 3.6, which is also on a healthy rate. And one key thing to note is their borrowing cost is on the low side of 2.3% compared to most of the REITs currently listed at SGX is 3% or higher. Their debt profile is pretty well diversified. There's no more than 20% going to mature in the next 4 years. And their weighted average debt to maturity is 3.9 years, which is pretty decent. And Capitalescort Trust have been on a transformation path. They have merged with Ascender Hospitality Trust, and this is why their hotel asset have increased. As part of number of their current hotel, it was from Ascender Hospitality Trust. And they are trying to have this target allocation of 25 to 30% on longer stay accommodation, which is the rental housing and the student accommodation. And these will indirectly result in more stability and more diversified income for this trust. However, one thing to note that when they're on this allocation path, this will mean that they will need to buy more properties. And with their current gearing and current size, along the way, there will be certain form of equity fundraising. So as an investor, you need to be aware of that when you're doing risk investment. This is a snapshot of their financial numbers of the Capitalescort Trust. Their market cap is about 3.6 billion, which is a good size to me as I'm looking for REITs have a market cap of more than 1 billion. Their dividend yield is 5.2%. To me, it's a reasonable dividend at this current market juncture where I'm looking for a dividend yield around 5% at this current market juncture. The REIT is currently trading at a slight discount. The price to book is 0.92 for hospitality trust. Due to the nature of their business, it's tough for hospitality trust to trade at a premium as the market will have some discount factor onto it. Thus, with the price to book at 9.2, currently the upside potential for Capitalescort Trust to me, I think is a bit limited at this juncture. Thus, I will continue to monitor this REIT for better entries. The second REIT in my reserve list is Fraser Centrepoint, which is a suburban mall REIT. It currently has 10 shopping malls and 1 office building, which is called the Central Plaza, that is linked to Tiong Bahru Plaza. From the map, you can see that most of their properties are in the north, northeast, and the east side of Singapore, with 1 in the central. Unfortunately, currently, they do not have any property on the west side of Singapore. After the acquisition of 50% of Next, together with their sponsor Fraser Property, they become the largest suburban landlord in Singapore. before the acquisition, they are on par with Capitalescort Integrated Commercial Trust. In future, if they were to further acquire more stakes on Next and maybe even Waterway Point, they will be even bigger when compared to CICT if CICT did not acquire any more suburban shopping mall. And this is the financial structure. Their current gearing is 39.6%, which is in a healthy range, but it's approaching 40, slightly more than 40 already. And their adjusted ICR is 4.39, which is very healthy. And their average cost of debt, as I mentioned, most of the REITs are above 3%. So it's nothing to be alarmed of. Their average debt to maturity is a bit short compared to the peers is at 1.91 year. So one thing to note about these REITs is their gearing is approaching 40s. And if they were to continue to do further acquisitions or like increase stake in Next, they may need to do some form of equity fundraising, be it private placement or preferential offers, or maybe even right issues in order for them to do further acquisition and also to bring down their gearing. This is the financial numbers of the REITs. Market cap is currently about 3.6 billion, which is about similar with Capitalescort Trust. And their dividend yield is also around 5%, which is 5.74, which to me is pretty reasonable at this juncture. And it is trading at a slight discount of 0.92. For Fraser Centrepoint, this REITs before COVID, it was constantly trading at a premium. And when COVID comes, shopping mall is affected. The price range usually hover around the NAV level. So it's around price to book 0.9 to 1.1, that range. So currently, you have not managed able to go back to the good old days at trading at a slightly better premium. I would expect this REIT should be able to trade at a premium in the long term. The last REIT in my reserve list is Capitalescort Integrated Commercial Trust. This REIT is the largest proxy for Singapore commercial real estate. And in fact, this REIT is the biggest REIT listed in Singapore in terms of market cap. The market cap is more than 13 billion, and it is a very Singapore-focused REIT where 93% or 21 out of their 26 property are in Singapore, and followed by they got 2 property in Germany and 3 property in Australia. And it's a pretty well mixed, is where 30% of their portfolio value are from shopping malls, 40% are from office that are located in CBD, and another 30% are from integrated development. For example, Raffles City, which have a shopping mall, have a convention center, and have an office building all in one. And look at their financial metrics. Their gearing is the highest among the 3 of them in my watch list, and it actually surpassed 40, although MAS cap is 50%. I'm a bit cautious when a REIT have crossed the 40% mark, as this may indirectly affect the risk from continue to grow to acquire property by debt financing. The interest cover ratio 3.4 is pretty healthy, and the cost of debt is 3.1. And the average term to maturity is on the long side, which is good. That is 4.2 years. So similarly, for this REIT, just like Fraser Centrepoint, if they were to do further acquisitions and want to bring down their gearing, they will need certain form of equity fundraising or divestment of properties in order for them to continue to grow. So this is one thing as an investor, we need to take note of that. This is the financial numbers. The market cap is 13 billion, which show that they are the market leaders. They are the largest in Singapore context. Their dividend is 5.32, which is on a healthy range at this market juncture and as also at a reasonable range. And they are also trading at a slight discount. Their price to book is 0.94. And these REITs were normally able to trade at a slight premium in normal market conditions. But since the COVID started and we have actually not 100% out of the wood yet, so there is some potential for this share price or REIT to move up further so that they are able to trade at the premium. This is the current 4 REITs I have, and we can see that I don't have a REIT under the hospitality trust category, so I can fit it in with Capitalescort Trust. As for shopping mall and office building, I prefer to have shopping mall and office that is in Singapore rather than overseas. And thus, I currently only have Mapletree Pan Asia Commercial Trust, which only have 1 shopping mall, which is VivoCity. Although it's a very good shopping mall, but unfortunately only 1. And of course, they got office building mainly on the outskirts of CBD. They only have one office building inside CBD at Anson Road. So to fill up the gap, I will either fill up with Fraser Center Point, which have 10 shopping malls around Singapore in the suburban region, or I can fill up using CICT, which have 23 properties in Singapore, and they have suburban shopping mall, they have downtown shopping mall, and they also have office building in CBD. My ideal REITs portfolio is to comprise of 6 REITs that are well diversified and cover different sector and different region. Currently, I only have 4 REITs in my portfolio, but I have restricted my portfolio to have only 10 Singapore stocks due to the current capital. As my capital will increase along the way as I every month add in 2,000 into the portfolio, I will definitely expand my portfolio for Singapore side with a target to up to 15 stocks. And by that time, I will able to add in 2 more REITs into the portfolio to complete my REITs portfolio. I will update again if I were to add in any more REITs going forward. And also the future update session, I also want to talk about the Singapore stocks, also the US stocks that is currently in my reserve list. If I feel that this video have benefit you, do remember to like, share, and leave your comment below. And lastly, do remember to subscribe and press the notification button so that you'll be notified on my next video. I shall see you in my next video. Bye-bye.